Welcome to FICC Focus, where Bloomberg Intelligence fixed income, credit, currency, and commodities strategists and analysts discuss their short and long-term views on debt markets and issuers. Now, here's the Bloomberg Intelligence FICC research team.
Good tidings there, listeners, and welcome to the latest edition of Credit Crunch, part of the FICC Focus podcast series where we focus on all things credit. I'm your host, Noel Hebert, and joining me, colleague Sam Geyer, each of us of Bloomberg Intelligence, the research arm of Bloomberg LP. Today, we're excited to be joined by Henry Song. Henry's going to be our last guest of 2024, so no pressure there, Henry. Henry is the portfolio manager over at Diamond Hill for strategies that include the firm's short-duration securitized bond strategy, the core and core plus strategies, intermediate bonds, and pretty much anything else that has a coupon on it. Henry, welcome to Credit Crunch.
Thank you guys for having me today.
So before we dive in, excited to have you here, of course. But like I said, there will be pressure because this is the end of the year and we're super, super popular. So high bar here. But before diving in, maybe just walk us through a little bit of the Diamond Hill platform, the credit platform within Diamond Hill and sort of what that looks like.
Yep, sure. So Diamond Hill is a boutique asset management firm that's focused on a single investment philosophy across different asset classes. And that philosophy is bottom-up security selection driven. So both of our equity and fixed income platform are invested in that way. And we have a strong commitment to our clients, and we like to align our incentives to really with the clients' success overall. And how does credit fit into Diamond Hill's strategy? So it's really a natural extension of our investment philosophy here. We really do deep credit work in our underwriting, and that we typically think about that from the equity perspective. But on the fixed income side, we think about us as bond pickers in the marketplace, and we really use that to. When we say bottom-up security selection driven, we really want 80% plus of our attribution coming from that. We are not big on, taking big macro bets, interest rate, curve, big bets like that. We really want to focus on finding bonds that are undervalued by the marketplace. And it's our experience, those bonds tend to do really well over time if you can find them. So that's where we spend most of our time.
So I don't want to maybe front run too much of the conversation, but it does beget some early questions in terms of what that bottom up process maybe looks like in sort of defining that sort of relative value position. I guess it depends on sort of where you are in terms of which asset class within credit you're sitting in, as well as where you are within the credit spectrum. But is that sort of more covenant work, or it's just like, hey, listen, we really like this sector, and we really like this name within the sector, and we want to be in this part of the curve, or how does that, maybe not too deep, because again, I think we'll probably come back to it, but I'm just sort of curious as a starting point.
Yeah, I think the underpinning philosophy we have is there are no bad bonds, but only bad prices, right? What really constitutes a situation where you have these opportunities, whether it's an overlooked sector, or sometimes it could be a one or two name in a sector that tend to be less well-known, maybe a less frequent issuer that doesn't get as much attention as a more frequent issuer. It doesn't necessarily mean they're worse quality. It just means they're potentially smaller. So you can think of them as, almost a small cap company in a space that's dominated by large cap players, right? So then there are other situations there are potentially maybe some headline risks. And those tend to be incidences where bonds can be oversold because of these headline risks. And we like to go in there, roll up our sleeves, and do the credit work and pick winners in the, what's might look like a distressed situation.
All right. So we'll dive into some of that in greater detail. But I guess maybe first, in terms of just introducing the audience to you here and talking a little bit about your own background in terms of your start in credit, what brought you to this point, what got you into Diamond Hill, and sort of what that journey has looked like for you.
Yeah, sure. So I started in the business in 2005. Actually, prior to that, the year prior, I did an internship at a bank that's no longer exist in its current form in
That wasn't
Chicago.
your fault, was it?
Oh, no, that was not.
Okay, just making sure. All right.
Yeah. GFC happened shortly after all that, right? So, but that's where I got my first exposure to the mortgage-backed securities market, interest rate default swaps, mortgage-backed securities. That was really my first exposure to the bond market. So I got really hooked into it, really liked the math and everything else behind the mortgage market. So in 2005, when I started out my career, I joined JP Morgan. And that's my first entry into the marketplace. And the first few years of my career, right up until 2008, was pretty calm. Everything was super rich, right? There's nothing too special, um, and really didn't. I would say didn't learn a whole lot until 2008 happened. When 2008 happened, I just happened to be very fortunate to be at a platform where we avoided the most of the subprime mess. We really didn't invest in that at the time. My former boss mentor really had the foresight to not touch that asset class. So even though we were known to be investing heavily in mortgages, we pretty much avoided the subprime mortgages entirely. And then actually our core bond fund at the time had a positive return in 2008, which was extremely rare at that time.
That's pretty impressive.
Right. So what transpired after that was interesting. Was a lot of the money managers that did poorly during that time lost a lot of business. So we took in a lot of portfolios from other failing managers at that point. Being a young guy on the desk, I kind of raised my hand and say, hey, can I work on transitioning these portfolios into our investment style? And that was my really big exposure into a lot of these non-agency mortgages, a lot of these subprime mortgages. So all the bonds that, my former boss never bought, I got to see all of them. So that's why I really got to start looking into the docs, looking at how these bonds are structured, why these bonds blew up and the way they did, and really dug into that side for the next few years. And then kind of as a natural growth in my career, as the market started to recover after 2009, the market recovery started. We saw a lot of emergence of a lot of these newer credit sectors come into play. A lot of these specialized lenders that came out, they were part of like a GE Capital, part of the bank, but with Dodd-Frank and other regulatory changes, these specialized lenders got spun out. And they needed funding. They no longer had cheap corporate debt funding. So like GE Capital probably spun out over a dozen specialty finance lenders after the GFC. And that was a great way for me to really look into a lot of these specialty lenders. And they were rather interesting businesses, right? They were all very successful business within GE Capital. And these business, all their lending platform were done really well. Got exposure to that, so started following that market. That really transcended the asset-backed securities market we know today versus what it was before GFC. Before GFC, it was largely your prime auto loans, your student loans, and some credit cards, prime credit cards. Post GFC, that market completely changed. Even though all these newer sectors with the growth of volume still haven't been recognized and put into the AG index. For a lot of the antiquated index eligibility rules, which we can get into if we want to, but they're not in the index. But these presents a ton of interesting opportunities. So then in 2016, I decided to leave JP Morgan. At the time, I was managing a lot of portfolios there. When I left JP Morgan to join Diamond Hill, the opportunity was to help Diamond Hill kind of branch out from equities into fixed income to build out the fixed income platform here. So I thought it was a pretty unique opportunity. So came to Diamond Hill. We started with a core bond fund. And then at the same time, we launched the short duration securitized bond fund, which is to really utilize a lot of these things I just mentioned, a lot of the short asset-backed securities, especially at the time, if you think back 2016 when the 10-year was like 1.25, people were starved for yield. And these short ABS bonds that we were buying were offering way more spread and all-in yield than 30-year corporates did, and they were short. And that was a great. So it was a great way to kind of put a stamp in the marketplace, saying, "Hey, we're offering something that's different, that's unique, that clients it's meeting client needs right now at a moment where people are starved for yield." 3.5% yield in 2016 was really attractive for a lot of folks. So that's kind of how we launched the. Besides core, we launched this credit, more of a sector play, pure play credit strategy, and then everything else at Diamond Hill that we offer in the last 8 years is kind of in the same vein that we don't want to be just launching a lot of products, but we want to offer products that meet client needs.
So let's maybe talk about the client a little bit there then, in terms of like, who is that sort of core client base? Is it an institutionally focused relationship? Is it high net worth? Like what's the client base look like in terms of who are these solutions tailored for?
Yeah, it's a mix. We have institutional clients, we have endowment foundations, but we also have a lot of high net worth clients that access us through some of the RIAs. So it's a nice mix.
So maybe let's change gears a little bit and turn into where the market is today and sort of what you're thinking of, and maybe we start by thinking about, since we are towards the end of the year here, in terms of 2024. What worked well, and maybe what surprised you both to the upside and the downside in terms of how 2024 played out.
Yeah, sure. I guess what worked well in 2024, what didn't? Everything did well, right?
Maybe not duration, but
Yeah,
depends
maybe
on the
not.
day.
Yeah. But in terms of credit, like from a spread perspective, anything you bought in Jan 1st probably done pretty well this year. So I just say I've been pretty surprised by the pace of rally recently in the last couple of months. It just feels like the market's overly optimistic of what's to come and ignoring a lot of the risk that's out there. As I mentioned, like we look at everything from a fundamental credit perspective, and the rally that we have seen in the last couple of months is very much detached from the credit fundamentals. And that's where my concern will be come in is it seems like there's too much market euphoria currently.
And is that true in terms of relative to the securitized side as well? I mean, you talked about sort of that being, at least when you got sort of started over there at Diamond Hill, being interesting place for you guys to sort of plant a flag and do something a little bit more novel that could offer a good sort of above average sort of return profile. Is that sort of where we are today in securitized still, or as that sort of relative value gap sort of compressed? And how do you think about the landscape there going forward?
Yeah, so let's just compare the securitized marketplace to the corporate market. There's going to be a spread pickup going from investment grade corporates or even high yield debt into securitized products. And that's really more so structural in nature. That spread gap between the two, that tend to fluctuate from time to time, depending on the overall market conditions. So that's what I say. Our view has always been the structured products, or we call securitized structure, kind of interchangeably. This marketplace, because of the sophistication it takes, or if you say, if you will, the lack of index inclusion in some of the subsectors, will always keep some of the investors out. So the first key reason for the spread pickup is just the sheer number of eyes that will be on the IG debt versus on securitized, and then also the sheer dollar amounts that's going to both marketplace. And the second part is, I mentioned they're not in the index, which means we don't just have this passive buying into into this place to drive the spreads in, and that can be extremely powerful when money are flowing to bond market. But if they're flowing to the passive, especially with the growth of ETF and everything, that's really not going to disrupt the securitized market nearly as much as it would disrupt the corporate market. The third thing I would say is just the sheer number of unique bonds, the number of CUSIPs that's actually available in the securitized marketplace is just staggering compared to the corporate market. And that makes trading very, very different. In the corporate market, with the rise of electronic trading, you can trade a corporate bonds these days in about a minute, right? Like you can go on market access, go on other. Bloomberg has a platform now as well that's growing. You can put a bond out there, or you can even put a entire portfolio out there and do a portfolio trades very, very efficiently and quickly. And on the other side, you have a lot of computers that's bidding these because there's so much more the corporate market is so much more transparent. It's easy to get levels, and you can have algorithm trading on the other side to really facilitate that. On the securitized side, that's just really not happening. It's something people have been working on. We have had a lot of different startups that's been trying to enter in the market and offer electronic trading. But just again, the sheer number of different bonds and the QSIPs just makes it extremely difficult to make it work. So the trading on the securitized side, we joke about we're stuck in the 80s. The only thing that ever changed is we're not literally picking up the phone and calling people anymore.
It was a great decade. Let's be honest.
Yeah.
There are a lot of good things about the 80s.
I wouldn't know though what happened in the
80s. Sam.
Yeah. Henry, so I mean, you kind of walked us through your background, some history around the space. I'm curious, looking forward from a monetary policy perspective, how are you seeing the market right now, just in terms of inflation and what the Fed might do? How are you modeling all that out on your end as well?
Yeah, I mean, I think we have always taken the view. The last couple of years, we've taken the view that the inflation is going to be very hard to get to the Fed's 2% target. It's going to take much longer than the market anticipated. And we're kind of sticking with that right now, especially with all the uncertainty with the new administration coming in. A lot of the policy can be quite inflationary. We think, that we're already seeing that right now. The last 1% or so of inflation is quite sticky and hard to it's hard to get to that 2% target. So I think we're going to stay higher rates for longer. That's kind of our base case view. But we've been saying that for the last couple of years, and I think that's still going to be true. But I think the wild card is, if anything, if inflation were to rear its ugly tail again, where would the long bonds go? Right. That's our bigger concern right now. We're not really pricing a lot of the Fed cuts. Obviously, a lot of the credit sectors would actually really benefit if there were a steep cuts that were coming through. Especially when we think about the mortgage market with the low housing turnover rates, because people are stuck with their mortgage. That will really benefit a lot of these markets that we invest in. But I just, we're not really putting that in our base case analysis.
So then, in terms of your portfolio and how that's positioned, how do you see that? You mentioned obviously the long bond and the impact there. Are there certain parts of the market, whether within the structured side or maybe within corporate credit, that you think could outperform in that particular environment?
Yeah, I think it's. I think there's a lot of bonds that can do well. I think first of all, I just wanted to say this. I think this is a great time to be a bond investor. There's not many times where you are going to get real positive yield. And I think that's the time as a bond investor you actually make money, right? We just went through over a decade of QE experience where if you invest in a bond market, you were actually getting negative real yield. We're getting real positive yield here. So for one, that's I think bonds are going to do well. And I think whether we get the cuts or not, you are getting good carry now, right? There's actually real yield. As I mentioned earlier, 2016, we're at over 1% on the 10-year, negative real yield. Today's market, you're getting real yield. So I think that's a good place. Now, I think if the long end's gonna, if the rates were gonna go higher on the long end, then these short-term structure securitized products are gonna do really, really well. Because again, they are short. And if rates were going to go higher, you can refinance or buy new securities very quickly. One of the big advantages of these securitized bonds, if you think about the ones backed by auto loans, your home mortgage, and everything else, there's a monthly principal component to it. And that was very helpful when rates were going higher in 2022 where Fed were doing the liftoff. Because if you invested a portfolio of these securities, we were getting a ton of our money back monthly without having to sell anything. So you don't have to deal with selling. You're getting money back and you get to reinvest them at a higher interest rates. So that's a very powerful tool that's kind of building into the structure of these bonds. So that's something that's very different than Treasury and corporates, where you take the mark to market loss, but you can't really do anything about it. You just have to deal with. You have to hold it.
So, I mean, obviously, like you just mentioned, kind of sounds like a pretty positive all around environment. But I'm wondering from your side, if there's one area of the market that you're a little pessimistic or maybe have some concerns about, is there something that really sticks out to you in the year ahead?
Yeah, I do think if the rates were to stay higher for longer, it does put a lot of credit pressure on the companies that's really need lower cost of financing, right? So I think there is real credit concerns coming through. I think there is concern in some of the sectors that's housing adjacent that needs a faster housing turnover to help the performance of underlying bonds. So those are sectors that's going to be under a lot of pressure for sure.
So then, kind of touching on that too, like there's data out there just in terms of impact for mid to lower income households and the pressure that they're feeling, versus higher income households aren't really feeling that pressure. Things are going pretty well overall for them. How does that play out? Obviously dealing with the securitized market, we're talking credit card loans, student loans, mortgage-backed securities, like you mentioned. So quite a few different areas where I could see that potentially impacting. I'm just curious from your side if you see it really playing out in one market over another.
Yeah, no, absolutely. We've been seeing that play out. And Sam, you're spot on. Because when I think about asset-backed securities market, you're really leveraged to the consumers, right? Whether it's credit card, auto payment, you are really just leveraged to the consumers. It's a great diversification away from corporates, but you're also taking on these risks that it's harder for consumers to get a bailout than a large corporation if they were to fail. So here's what we've been seeing the last few years. In 21 and 22, we have seen a lot of deals have a real uptick in delinquency and defaults. And we have seen that kind of play out already. And those were, I think if you think about these bonds backed by these loans, they are kind of, vintage specific, right? Like it's like, an issuer goes out there, they will, like a unsecured consumer lender, they will issue, say, $1 billion a year. And every quarter they will securitize their portfolio, they move on, they get the money back, they lend out again. So every batch is a little bit different. So the vintage really matters here. And what we have seen all this data is, to your point, the lower income income borrowers have had their share of default has really spiked during those vintages. And talking to some of these lenders, some of them even came out and said if they were lending today, half the people that lent to you back in 2021 and 2022 would no longer be eligible for the loans. So then fast forward the 23 and the more recent 2024 vintages, they're performing great. And so we're already seeing this clear bifurcation of what happened a couple of years ago and what's now. Even though the asset-backed securities market does deal with a lot of the, called the near prime, the subprime cohorts of the consumer base quite a bit, even that universe has shrunk quite a bit till today.
Is that just a function of like what was happening around the COVID stuff and all the dollar distributions, such that 2020, 2021, obviously there were a lot of checks being sent out to aid sort of lower income households and that sort of thing, which I would presume raised the amount of credit that they were being offered. And obviously, as those dollars went away, I would presume that that's a fueling source. Is that the case?
That's definitely half of it. I think the other half of the issue was all the lenders pulled back right when COVID hit. A lot of the lenders, so they had a terrible 2020, right? So they didn't make any loans, they weren't making money, and then they saw the we saw what happened in 21 with the stock market rally, and everyone had money in their pocket, everybody's spending, and all the consumers. I think it's not just a stimulus money that went into everyone's pockets that helped the performance, but it's also the fact that during lockdown or limited lockdown, depends on where you live, people weren't spending as much money as they did before. They weren't going out to eat as frequently as they used to, right? It doesn't matter what states you lived in at the time. You didn't have nearly as many opportunities to spend money like you did pre-COVID. So people didn't spend as much. And that was a huge component of it. So it's not just the fact that federal stimulus check give you extra income, but it's also on the spending side was dramatically reduced at that point. So those are the two factors. And I think a lot of lenders, they also as I mentioned, they had a rough 2020, and they really want to make up the volume in 2021, 2022, and got ahead of themselves a little bit. So they went almost too tight in their credit box in post COVID, and then they loosened up too widely again. So I think a lot of them all learned that lesson, and now we're kind of to a more rational place again. And to Sam's first question about the consumer that's done better, I think there's continue. I think that's why when you look at the overall consumer picture by all the metrics, the consumer landscape looks great. But again, it's heavily uplifted by the best cohorts, right? The people who you look at how well the stock market is doing. But as we know, when you look at all the indication, not even half of the U.S. population own a lot of stocks in the portfolio, but those do. They have really benefit from all this rally, right? S&P up 25% this year. People are feeling great. They're spending more than they used to. So the overall picture of the consumer is really masking the poor performance of the lower income consumers here.
So then, is there a particular part of the market in your eyes that you think maybe has gotten a little ahead of itself? And just from Noel and I's perspective, something like corporate bond spreads, whether you're looking at investment grade or high yield, obviously really, really tight, with a lot of that kind of pulled forward from expectations around Fed cutting rates and the economy staying pretty solid. Is there, in your eyes, a part of the market that you think might be a little too far ahead?
Yeah, I think I agree. My view is the corporate bond market, the high quality investment grade names, and a lot of the higher quality double B high yield names are trading way too tight right now. That if the Fed cut weren't materialized, those bonds will widen out quite a bit. So just to give you an example, right? Like recently just saw a lot of the bonds being trading. We see Apple bonds, 7-year Apple bond is trading 10 basis point spread over comparable treasuries. 10 basis point, right? Why would anyone in their right mind be buying that? Well, they're buying that because they like the overall yield they're getting, and they think, Apple, it's actually a higher credit rating than the U.S. government. It's money good. You can buy that, but that bond only makes sense if you assume the rate cut is coming and the spread's going to normalize through a rate cut. If the rate cut isn't materialized, then that spread's not going to stay at 10. It's going to go to 25, 30, right? So I do think a lot of those names benefit from that. I think if you look at this year in 2024, the 10-year traded 10-year treasury fluctuating in about little over 100 basis point in the range. But if you look at the all-in yield of corporate, if you just use IG, it's much, much tighter than that. The range is like 30-ish basis points. That's, again, people are buying, they have a certain yield in mind they're targeting, and they feel like they're getting compensated for it for the longer-term risk they're taking. Kind of to the concept I mentioned earlier about real interest rate. So that if they feel like they're getting compensated enough, they're kind of overlooking the spread aspect of it, which in my view, it's not sustainable. Again, it's a short-term bet on the Fed's gonna cut. So I do think it's kind of ahead of itself in that sense. That if it doesn't materialize, then you're gonna see spread widen out.
Yeah, I certainly agree with that. I guess one of the questions that I'd have on the top of that too is thinking about, because one of the things that's sort of changed even over the last, call it 3 to 4 months, in terms of how people are thinking about monetary policy, it's not just that the Fed's going to cut, but now people are sort of starting to think about, maybe to your earlier point about a stickier inflation dynamic, that maybe it's not this parallel shift lower in the curve, that suddenly we're going to get this steepener, or maybe you get some volatility out of the front end where front end rates come down, but everything else maybe stays a little bit stickier, which doesn't really help the duration part of the curve. I guess, do you think about that at all? I mean, because it seems to me when we speak about that tight spread that you're talking about, and I'm definitely in agreement, Sam and I will talk about that. Basically, you can almost time it back to, October of 22, when the Fed was basically like, hey, listen, we don't know when we're going to cut, but we're definitely not going to raise anymore. And that just sort of like opened the gates in terms of people sort of chasing after duration, which, absent a pivot in that where they maybe raise the prospect of moving higher on rates, I guess I have a hard time personally thinking like what's going to change the mindset where investors become less comfortable with duration. Is there a scenario where you go, hey, listen, we think that there's actually a risk to duration, or is it just a function where it's just less compelling?
I think it's more the latter. It just becomes less compelling. I think a lot of investors, to your point, after 2020, late 2022, jumped into the bond market. We saw that in the flow of money coming to the bond market. But a lot of that money was hoping for a quick Fed cut, right? It didn't materialize in 2023, didn't
Or six of
materialize
them, as
this
the
year.
case may be. Yeah.
Yeah. But, again, the downside is also fairly limited, right? Because as I mentioned, you're getting pretty good yield right now. So, okay, you didn't get the big duration lift that you were hoping for. You didn't get the double-digit return, but you still clip above, positive real yield there. So it's not a bad place to be. Obviously, compared to what you could have gotten in the stock market, you could argue, okay, that was a bad timing in hindsight. But really, risk is fairly limited. So I think it's the same thing here. I think I tend to agree with you on maybe the front end will come down, but the curve's going to be, maybe a more normal shape. But it's the long end is going to be potentially fairly sticky here. We're already the 10 years gone between 4% and 5%, and fairly volatile the last couple of years. A few times we have seen that play out. We're kind of we're at 4.3% today. Seems fair, but I would not be surprised we see 475 get again. So that's certainly on the card. So you have some downside, but it's minimal. It's the downside. You have enough coupon and carry on the bonds, meaning even if 10 year were to go 40, 50 basis point wider, you have enough coupon income to offset that. So you're not going to be faced with what we saw in 2022 when bonds had no coupon to deal with that sort of large movement by the Fed liftoff.
Yeah, and I think that's certainly an important factor. I guess maybe staying with sort of, I guess we'll call this sort of a relative value discussion, but given that and sort of those views around parts of the curve or the longer end of the curve, is there sort of a part of the curve that you find a little bit more attractive, be it the belly or maybe it is that front end? And similarly speaking, with spreads tight, obviously you have some beta adjustment as you move down in credit quality. Is there a part of the credit quality spectrum where you want to be, relative to others in these days?
Yeah, so your first question about the curve, I do think the front end of the curve looks very attractive right now, just because the curve is still overall inverted. It's between 0 and 2 years. So it's great carry on the front end. So I think that's very, very attractive. Obviously, in a portfolio, you want to kind of make sure you have enough duration in case there is a duration benefit or a flight to quality or anything like that. You're protected from that perspective. So, again, kind of going back to our investment philosophy, we really just look for bonds where it makes the most sense. Sometimes you find a bond that's like 10-year that makes sense, and sure, you buy it. If you find a bond that's 20-year makes sense, you buy that. Then when we think about where on the curve, it's more of a portfolio construction concept where we will come in and look at our portfolio and say, okay, we found these bonds that we really like across the curve, but are we missing any parts on the curve that we don't want to be complete cutoff side? That's where we kind of fill in with treasuries and others a little bit to kind of make sure we don't go too offside. But we don't go in with a mindset we're going to only buy bonds on a certain part of the curve because we love that part of the curve. So that's not
So
how
I
we kind
guess
of
that
approach that.
Yeah, I mean, that's a really interesting point in terms of filling in with the treasuries there. And I guess I'm kind of curious, do you also kind of say, hey, listen, we like this name, but, basically, we need a duration weight of X, but we can only find the bond with a duration of X plus Y. And so do you shade the exposure, or is it just sort of, to your point, maybe you're just balancing it off with a shorter duration piece, whether it's treasuries or otherwise, to sort of find that right balance?
Yeah, I think it's a little bit both. You try to buy as much of the bonds you really like within your risk tolerance, right? Like we try to find bonds I really like, as long as we're comfortable with it, and then look for treasury or longer treasury strips to really help you like shore up the gaps along the way. Um, I think one of the things that we think about a lot is every portfolio serves a different needs. So it really varies from portfolio to portfolio. Like what type our risk tolerance is different. Like core versus core plus, it's going to have very different risk tolerance. Short duration securitized, it's again it has a name short duration and securitized, so the focus is very different. So in that portfolio, we're not really messing too much with the curve or anything like that. Uh, that's more of just a sector play. That's more of a short duration focused sector strategy. So it really depends on the strategy. We think about it a little bit slightly differently, but the overall idea is we want to use the least amount of risk to achieve our return objectives and minimize the downside.
Yeah. So maybe let's dig into that securitized piece a little bit, because as you mentioned, you're not really playing duration because you're going to be, short dated. So I'm assuming that's generally going to be 18 months and in, or maybe 2 years and in, or something like that. So I guess relative value in that part of the curve, is it purely sort of a spread game, or is it really kind of like sectors you like or don't like? Because at the end of the day, if you're, a sub 1 year duration and you underperform by 20 basis points, it's really not. I mean, I don't know if you're indexed against anything there, but it's not going to really impact anything unless you get some real big hiccups where stuff actually kind of goes underwater.
Well, that you just hit it spot on right there. Then that is really the biggest risk. You pick a bond that's going to lose money, you really don't have time to recover. So credit work is paramount in that space. Um, so if you pick winners, then it really comes down to just where you're getting compensated for, um, how if you're finding the right relative value, because there's no great benchmark for the front end space. Most of the bonds that's kind of in this asset backed securities that's short are not really in the index. So there's really not a great benchmark, right? So it's really comparing and making sure that you find bonds that can work well together. Ultimately, we end up building a portfolio that's almost like a ladder. It's almost like a ladder out portfolio that's up to 3 years. As I mentioned, a lot of these bonds have a monthly principal components coming back to the portfolio. And I often think of this particular portfolio as one, if you don't touch it, we just say, hey, we'll stop reinvesting the money. In 3 years, you're going to get 90% plus your money back. So it's self-liquidating at a very rapid pace.
So I guess that opens up another interesting conversation, because I think, we don't have a lot of portfolio manager conversations on this particular podcast. So it's a great conversation to have. But I guess maybe when you walk into the door every morning, sort of you sit down at your desk and all the screens blink on and that sort of thing, what are the first things that you're sort of looking about? How do you start your day in terms of just sort of looking for first, like, did something happen overnight that I need to be mindful of? Is it looking at sort of like where, for the stuff that's maybe benchmark, am I out of balance, whether it's a sector exposure or duration exposure, et cetera? Or maybe it's like reinvesting those cash flows. Like, what's the sort of the morning look like?
Yeah, I think the typical cliche answer: you read the news and you start the day looking at cash flows, right? So all of that's involved, right? So but then really I think what differentiates how we're approaching this particular market that's different than say some other markets or equity guys. It's really when I come in, I have an idea what type of money I need to put to work, how much money I need to put to work. And the question I have is, okay, what's going to be available today? What's going to be coming out in the new issue market? So you got to monitor that. What new issue is going to come, and then you're going to look for opportunities in the secondary market. Typically, you can look at all the dealer inventories, and those don't change too much. You kind of have a pretty good idea where those are. But what you don't and you can't anticipate until you show up is what sort of bonds other clients, other end accounts are looking to sell that day. Um, we kind of had the conversation about electronic trading earlier about corporate bonds. Kind of back to what I mentioned, this structured products where back in the 80s is the trading process is very different. If someone's going to look to sell some bonds, they need to put it out and they need to give people typically 2 or 3 hours or even more time, depending on how many line items are they're putting on the bid list. So every morning I come in and you just start seeing this bid list coming out, and dealers will aggregate them, right? For example, Goldman will send out, hey, today's ABS bid list, and they will keep adding to it as more clients put out the list. Like if I want to sell bonds, I'm going to put it out too and jump in the queue. So you end up seeing, okay, all right, here are 200 bonds, different clients looking to sell at different times. What bonds you want to really bid on? So you kind of spend the morning kind of formulate a plan. It's like, okay, I like bond A that fits what I'm looking for right now, like bond B. So you kind of go through the list, and then you come up with a plan. You work on those bonds, making sure you do maybe a quick credit refresh or something like that you want to make sure these are still bonds you want to own, and then kind of make sure you're finding enough market comp and data to get a good sense where you want to bid these bonds. And then the entire bidding process is anywhere between 30 minutes to multiple hours. So it can be a very tedious process. And a joke, it's almost like you go in the flea market, you're haggling back and forth with the seller half the time. So it's a very, very old school process, except we don't use the phone anymore. Young people don't like to use the phone anymore. They prefer to use Bloomberg Instant Bloomberg.
Always a little bit easier though, huh?
Yeah.
So I'm curious though, from the technology standpoint. Obviously, you mentioned securitized market. There's not a lot of automated trading or portfolio trading that's going on there. But for you all, how does the technology side kind of play a part in picking these different bonds? Whether that's figuring out what type of exposure you want. Maybe it's on the securitized side, looking at the underlying cash flows and everything. How are you all using technology and leveraging that?
Yeah, there's a lot of different technology involved in this particular space. That's also another reason it's keeping the bar a little bit higher for for people to enter the marketplace. We're not looking at 10Ks, for example, but we're looking at the underlying performance. There are different ways to access that. But most of these deals come out with what we call monthly remittance. So every month, a deal will come out, say, hey, this is how much money we collected. This is how many people defaulted. This is a recovery from the defaults from 3 months ago, recovery from defaults 2 months ago. You get a lot of data, right? There's just a ton of numbers you're dealing with in this particular space. So you analyze, so we look at it. We have systems we can use. We have third-party sources. Some of them, and a lot of it is on Bloomberg as well. And Bloomberg has really improved over the years in this particular space to get really good at it. But you can analyze trends, looking at different things. So that's one part of it. And the other big part of it is what we call scenario analysis. In this instance, where if you look at a pool of 5-year auto loans, you want to figure out how the loss is going to come through and the timing. You want to model that out. So there are different tools you can use. Again, Bloomberg being one of them. There are other third-party sources you can use to give your own inputs in this space. When it comes to analyzing losses, it's not just saying, okay, this bond's going to have a 5% loss at the end of the day, but it's about how you get to that 5%. Is it more front-end loaded, back-end loaded? Can you shock this in some ways? What happens? GFC event happens. Unemployment goes 10% for a year. What kind of loss multiple? We can model all of that. That's what we do. So we use a lot of these tools and technology to model the bonds and figure out the different outcomes, and also to figure out where the bond breaks. I think it's critical to think about. Well, maybe I'm going off tangent a little bit here, but I think the idea of securitized bonds, when we think about rating, it's a very different concept than corporates. All right, in the corporate world, if we own bond from corporate A, we just want to make sure that bond doesn't ever default. In this securitized space, especially dealing with consumer, we're always dealing with defaults. There's always going to be losses. The answer we are trying to solve for is at what loss multiple will our bond actually have a default? The underlying consumer, if I pull of assets of 1,000 different consumer loans, there will always be default. It's just how much loss can our bond withstand. So it's a loss coverage. That's what we're trying to solve for and analyze. And we use all these other technologies to solve that. And the technology has come a very long way in this marketplace. It has made our job much easier, and the math and everything, the computational power has made it very easy to model these different scenarios. So I think that's one of the bigger change in the last probably really post GFC. A lot of things have really come on.
So, I mean, I love the technology side, so you're allowed to go on tangents for as long as you like around that. So I am curious, though, from the equity side. So you mentioned Diamond Hill has, the equity side of the firm. How do you kind of work with them, if you do at all, just in terms of like resources there? Are you guys collaborating with them at all on certain aspects of these deals?
Yeah, absolutely. On the corporate side, it's pretty easy, right? Because if the analyst covering a name, we obviously want their input on it. On the securitized side, there's a little bit less overlap, but there will be issuers that's being covered by our equity analysts as well. So in those instances, it'd be great to get their take on how they think about the issuer and get their take on it too. Because we kind of frankly do a little bit of underwriting ourselves, except we don't dig into the financials too much. I mean, we dig in a little bit to make sure, like for me, from the bond perspective, I want to make sure the issuer is not going to go out of business anytime soon. But if they do, that's still not end of the world, right? Because all these assets are sitting at SPV, and the issuer can go out of business. The assets are bankruptcy remote. They are not really touched. I mean, throughout my career, I've seen a lot of issuers go out of business, but the bonds can continue to perform just fine in this space. But you deal with like servicing transfers, some servicer interruptions. Those are not exactly what you want from a bond investment perspective. So I will absolutely, if I can seek input from someone else to get that sort of outlook on the company, that's very helpful. But again, to the extent there's some sort of overlap, but that doesn't always happen.
So I want to jump into kind of the securitized and get into the details there. For the ABS market, a lot of different segments: autos, credit cards. You mentioned student loans, and I think there's quite a few other esoteric type parts of that market. For you, are there specific segments there that you prefer? Are there parts of the market that you don't touch typically, just because of certain risks that might live in different parts of that market?
Sure. We're open to pretty much everything that, as long as we feel like we can analyze and properly understand the risk, we'll invest in it. So we have exposure in a lot of the more, call it off the run sectors that's newer to the marketplace. There are only really just two spaces that we don't really invest in. They're pretty big. We do not invest in CLOs, and we do not invest in whole business securitizations for different reasons. CLOs, we just don't think we have a great way of understanding all the leverage loans that's beneath the tranche, and they're being actively managed by another manager. That's just not something that we feel like that's where we have an edge in analyzing those. Whole business securitization, our view is that's really a corporate bond in disguise. We think they're putting some structural features and coming to the ABS market, gets the investment grade rating. Frankly, I think that's an arbitrage on the rating system and where they can get the best financing. I don't necessarily dislike all those businesses, but I just don't think I'm getting properly compensated for the risk I'm actually taking, compared to some other ABS deals that I can perfectly understand better, and I think it's more streamlined and fits the ABS market better. I just don't think I'm getting compensated enough for what I'm getting involved there.
And earlier you mentioned kind of in your morning routine, primary versus secondary market exposure. How do you think about that in terms of preference for one or the other? Are there certain, parts of the cycle maybe where you're going to be active in the primary market or secondary market?
Yeah, that's exactly. I think it's a market market dictates that, right? If you're in a bull market, there's going to be very little secondary trading. Dealers can't keep bonds in the inventory, and your only chance of really putting a lot of money to work is through primary market. And in a bull market, all the lenders would like to access a market too. They get great execution. They can get, so there's no shortage of supply coming through the primary market. Conversely, in like 2022, 2023, when Fed was doing liftoff, people didn't want to buy short-term bonds anymore at that point. We saw a lot of outflow in short-term bond category altogether. That put a huge pressure on the new issue market. Because if you think about this market, it's heavily dependent on these short duration type of funds bond funds buying these assets. They're not only not buying during that time, they were also net selling, and so that put a huge amount of pressure. So the secondary bonds, you were able to pick them up really, really cheap, and there were plenty of them because there was so much selling that took place in those 2 years. So again, so it's really market cycle dependent where we end up spending and focusing our time.
So maybe staying within sort of the structured / securitized space, but moving on to some assets that, maybe starting with CMBS, right? I mean, I think a year and change ago, it was sort of the sky is falling and you couldn't hear enough about it. And then I think, pretty much for the last 12 months, I can't remember the last news story that I've read, except for maybe an odd lot like, hey, this is still a problem. I guess, how are you thinking about sort of the CMBS market? And I guess maybe most specifically about the office property space. And when you look across that universe, are there areas that you're more or less concerned about?
Well, it's funny. Like, I didn't get into this earlier, but one of my more, not macro, but more micro concern is what's happening in the CMBS office space in the last few months. We have seen nothing but one-way rally, while the fundamentals has absolutely not changed. It has not really improved by any means, but we've seen the bonds trading up. Some of them are trading up over 10 points. So the CMBS market, I think, the sky is not falling, but it's not looking prettier than it has been. It's very much the same in some ways. So let's see. 2 years ago, there were, was a rate move. All these properties were underwater, even the high quality assets. Even you talk about newer multifamily, because people just pay too much for it, right? People were paying 3.5%, 4% cap rate for these properties. And then you have 10-year treasury yielding more than 4%, right? Cap rate is just a simple measure of revenue divided by the property price, right? This is a very simple measure. So cap rates is really pegged, just a spread to what do you think the long-term treasury yield is going to be. So you don't look at short-term treasury yield, but you're thinking, okay, long-term, if 3% is a rational level, 3.5% cap rate still doesn't make sense, right? So cap rate, so that was a big issue. So we're dealing with that. I think the only thing really changed in the CMBS space in the last year or so is the fact that we have seen a lot more transaction taking place. So we have a little bit more clarity now to how some of these office buildings going to get resolved. And we also have another year worth of data to give us a better sense whether building A is going to continue to become an office 5 years from now. I think that's very important. I think that's what everyone's really trying to figure out, right? Like, is this office in Manhattan still going to be office, or is it going to be converted into a multifamily or get blown up altogether and sell as a land value, right? So that's, as time goes on, we have more clarity for that question. But the financing part of it is still tricky. But the good news piece is we're seeing the stronger sponsors who have a long-term bullish view on their property are saying, okay, all right, we're going to go raise some money. We're going to put equity in to refinance these properties to solve our short-term financing issue. We're just not going to be able to cash out. Instead, I'm going to cash in, refinance, and take care of the issue. So that's what's kind of created some of the positive momentum for the CMBS market. But again, that's on really high quality properties with a well-capitalized sponsor. So it does not address the not well capitalized sponsor or properties that's still kind of in limbo, and we still have a ton of that we need to work through. So there's a huge backlog of deals that need to get worked through in the next few years.
Yeah.
Um,
Big difference between AA plus and everything else, right? So,
Yep, huge difference. And the new deals getting done. Everyone's getting them done on a 5-year basis because no one wants this expensive financing. Everyone thinks rates going to be lower. So as these deals get done, they will get a 5-year fixed rate versus 10-year. So, so let's start the clock. 5
yeah.
years from now, we're going to be dealing with this again, right? We have a backlog we haven't resolved. In a few years, we're going to talk about all the stuff that got done in 2024.
Yeah, that's always sort of can be a dangerous game, but certainly positioning for a view on rates. But maybe sort of wrapping up on this side of the ledger and thinking about sort of the RMBS space. And I had the opportunity to listen to one of your colleagues do a podcast not too long ago on like the upswing that you're seeing in sort of the home equity side. So as we think about sort of the residential space and whether it's those home equity pieces or just the mortgages themselves, is there a segment within residential that you think about that you like? Do you worry about sort of the unaffordability dynamic that gets frequently cited in some of the valuations that we're seeing in the space? Or is it sort of a thing where, hey, listen, it's going to be a while for supply to catch up, so valuation disconnect be darned, this is probably okay.
All right. So the valuation aspect of it. So I understand that both sides of the argument there. So I would take another step back here. If you were to look at affordability of housing, it's a lot less affordable today than it was 10 years ago, 15 years ago in the United States. But if you were to look at affordability of housing in the United States versus the rest of the world, we're still wildly more affordable than Europe and then most of Asia. So it depends on who you really compare this to, right? So I do think we are getting pulled more into a global norm here for for home ownership, the cost and the delayed home ownership, right? People are renting longer now than it has to be. Uh, so I think depends on your perspective. So from my perspective, I think okay, while it's a lot less affordable compared to the income and how much we spend on our income to get into the housing market, it's not terrible. And then you couple that with a supply picture. We just haven't built enough homes to even for replacement, let alone match with the growth of population growth in this country. So that is going to put a floor to where the home price can really fall to. Again, obviously, real estate markets, location, 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 right? There's always outliers to this, but overall, the housing picture is still fairly healthy. I'm not anticipating housing market to continue this rapid growth. The price increase growth that we saw post COVID. I'm not expecting that, but I'm not expecting like a GFC style like huge drop in valuation. I just don't think that's. We have so much. We have the income level of this country is still so high, and we have seen all these record like labor union contracts being struck. People have more money in their pocket, so the base level, and along with inflation, the base level what people can afford is higher than what it used to be too. So I think those are the things that's kind of putting a floor to the housing market. So I'm bullish on on anything that's housing related. Um, so whether it be a residential mortgage-backed securities or single family rental deals or the multifamily market in the CMBS, I'm pretty bullish in there, not necessarily in the rent growth aspect, but in the occupancy and people making the timely payments aspect of it.
So, Henry, a little bit more reflective of a question here. Thinking back, you've been at the firm for almost a decade now. What about the culture at Diamond Hill has kept you there for that amount of time and has really helped the firm in terms of the success that you've all seen?
Yeah, I think a big part of Diamond Hill that I really value is how flat of organization that we are. I think it's we're 100 plus associates. Most of us don't really have a title except the job you do. I do think that's really great, and people are very open to sharing ideas. I reflect back thinking, but when I was at JP Morgan, it's a huge global organization. Our investment team is who knows how many thousands of people, right? We have experts in had experts in like every field. But what are the odds you actually get to like sit with someone and share some ideas across asset classes and stuff? It's almost never. Whereas I think Diamond Hill, that's been so flat and easy to work with the folks, and everybody basically has open door policy. I really value that. I think that's really great, especially from like investment team's perspective. You do want to get outside perspective. You want to hear as much as you can from even just things that's slightly unrelated, but just constantly getting hearing. I love hearing what my equity colleagues are talking about, what they're thinking daily, and their views on the market. I think that really helped me to be a better investor. So that's a really big part of it. I think just working with team players is always really enjoyable, to work with people that want to be team players, that don't want to be defined to a very singular role. I think that's something that really stands out with me, especially compare and contrast with JP Morgan. Just a very, very different culture from it's just, it's almost out of necessity that people here wear multiple hats, and I really like that about our firm.
Yeah, I think it's always great and sort of dynamic to be in an environment where you're being asked to think in sort of a bigger way. But Henry, thanks so much for joining us today. And I say to you and the Diamond Hill team, certainly happy holidays. And to our listeners, may you have a safe and merry holiday season, and certainly a prosperous new year. On behalf of myself and Sam, until next time, this has been Credit Crunch.